Hey guys, how are you? We are here in Bronzeville at Guaranteed Rate Affinity with Natasha Robinson and Angela, and they are going to talk to you guys today about a thing that I do not like, taxes. Okay, so we are going to help you guys to figure out what you need to do to be able to buy and what you need to do to get ready to buy. And if you already own, what write-offs are you maybe not getting that are deserving that you deserve, right? So we are here, and like without too many of you, because why? Because it's the polls tonight. So I hope everybody did their voting today. But we are happy to see you here. What we are going to do is we're going to introduce Angela, who is been in the business how long?
About 20 years.
20 years. Come on in, Ange. And so we have all used her, so we all know that she is going to be really great for you guys. And so if you have questions, please put them down in the chat. We will see them and we will ask. And then she is going to go over a flyer, or no, a handout. If you guys want the handout, all you do is put an email and we will get it to you. Okay, guys, I'm going to let her start.
Good evening, everyone. My name is Angela Mills. I am a professional tax preparer, and I've been an accountant for 20 plus years now. I just want to get you guys comfortable with filing your taxes. Some of the advantages of filing your taxes are, most importantly, so a lot of people get money back. You want to avoid any penalties and interest. Well, filing your taxes, you also protect your credit. You want to file your taxes so you can get an accurate financial picture of your income. You can use your taxes to apply for things like financial aid for your kids. Also, filing your taxes helps build your Social Security benefit. So those are some of the reasons that you do want to file your taxes annually. Now, when filing your taxes, there are two types of income that we'd like to discuss. There is an earned income and an unearned income. So, of course, everyone knows the earned income comes from things like W-2 wages and 1099s, salaries and bonuses, and any commission. Now, the unearned income will come from things like when you have a house, so investments, or retirement, or any type of passive income that you have. So those would be the two types of income you would have and that you would need to file taxes on. Now, just a simple quote, a wise young man or wage earner of today's invests his money in real estate. Real estate is one of the great investments of young people and old people, or anyone. Real estate is a great investment. Now, also, we want to discuss deductions for your taxes. And this is one of the things that scares people when they're doing their taxes. They don't know which way to go. They don't know if they want to do a standard deduction or an itemized deduction. They don't know the difference between the two. And they would need to speak with a tax professional to direct them in that way. Now, most people will take the standard deduction, and the standard deduction is based on the type of filing that you do. So whether you file single, head of household, married filing jointly, or married filing separate, the amount of your standard deduction will depend on that solely. Now, the difference between the standard deduction and the itemized deduction is the standard deduction is one single lump sum. But the itemized deduction is when your taxable, your liability is large, and then you have deductions that exceed that standard deduction. So as a tax professional, what I want to do for you is get the largest deduction that you're eligible for legally. Generally, the larger deductions that you will receive on your tax returns, three of the largest are your mortgage interest if you own a home, your real estate interest, also if you own a home, and then charitable deductions is another great deduction if you're doing itemized. And there are different dollar amounts for the standard deduction. Now, if you're filing a single status for 2022, the standard deduction, let's just say, for example, would be $12,950. But if you have mortgage interest and you have real estate interest and you have contributions and other deductions that will exceed that amount, as a tax professional, we would want you to take the itemized deduction, so that will reduce your liability and maximize your tax earnings. Now, the one thing that I did want to make mention of is a lot of people would prefer to rent as opposed to purchasing a home. Now, you would want to have the benefit of purchasing a home. You would have a lot of great tax deductions when you do so. As I discussed before, mortgage interest would be a great deduction, charitable contributions, real estate taxes would also be a great deduction, state and local real estate taxes. Also, you have that mortgage interest premium as a tax deduction. So you'd want to take all of that into consideration. Did you guys have any questions up until this point?
No. Not yet.
Not yet. Okay. So let's dig into a few things that will be taking place in 2020 when you're filing your 2023 taxes. So for a start, the tax filing deadline is April 18th. If you're going to be filing your taxes after April 18th, you would need to file for an extension. Now, if you are in the process of purchasing a home and you file for an extension does not mean that you have an extended time for the payment. So you do still, if you have a tax liability and you file the extension, you do need to make sure you satisfy that tax payment before your purchase. So also for 2022, there was an increase in the standard deduction for single taxpayers and taxpayers for married filing jointly. And that tax dollar amount is $12,950. Another thing that changed in 2022 is the income tax bracket went up due to inflation. There was a standard deduction increase in 2022, and all of that information will be in the flyer that I have. If there's additional information you need to know in regards to filing your taxes, the things that would help you when you're trying to purchase a home, the things that you need to do prior to purchasing a home, the deductions that you would have if you are running a business, you can reach out to me directly. My website is www.aeistewards.com. You can also reach me on my cell phone at 312-221-8774. Thank you.
All right, you guys. So I just had asked if anybody has any questions. So please put them here. We will answer them while the professional's here, because as I tell you, this is my most not favorite topic, a little daunting for me. So we want to make sure, oh, sorry, got my glasses on. Sorry, y'all. So we want to make sure that you get your questions answered today. Angela will still be here for a few minutes, but now we're going to have Natasha, who has us in this beautiful space, and she is going to answer any of your lending questions, and I know you guys have them. So put them in the chat and we will get them. Here comes Natasha.
Hello, everyone. I am Natasha Robinson, also known as Loans by Natasha, which you can follow me on Instagram and social media for more updates as it relates to purchasing a home. So today we're talking about a very important subject. A lot of clients are not self-employed every day. I mean, they work in a separate business other than their job, but they do have businesses on their tax returns. Some of these businesses are businesses that they know about from my experience with my clients, and some of these businesses are businesses that were created by their accountants just so they can maximize profits on their tax returns. When you are filing your tax returns, it is very important that you do give factual information about what is going on with you, but you have to be mindful that if you do have certain businesses and you are taking losses for those businesses, and we do have multiple types of loans. So the things that I say today are not going to be the same for FHA loan, for a VA loan, or for a conventional loan. But if you are self-employed and you are filing your taxes, and that is your business, and you are getting a tax refund, then it's very likely you will not qualify for a mortgage in most situations because you have to file taxes and pay taxes on the income that you make. The only income we can use for your mortgage is the income that you actually pay taxes on. So example, if you have a business that you made $150,000, right? And you had $120,000 in losses, then now you have $30,000 in taxable income that you're actually gonna pay taxes on, and that's pretty much what we use. Now, because there are certain things that the government knows that are gonna happen or not happen, you are able to write off depreciation, right? And other things. So there are some things such as your miles on your car and things like that you can have add back. But not to go into a very long talk about tax returns on the mortgage side, I just wanted to give you those scenarios so that you can understand that when you are filing your tax returns, what you file can definitely affect your mortgage. Another thing I would like to talk about today is your tax refund. If you're purchasing a home with most lenders, definitely with guaranteed rate, we do not require tax returns if you are not self-employed. What that means is that if you don't have business losses and you are not self-employed, I only need your W-2s, your pay stubs, and 1-month bank statements to get you pre-approved. However, on our underwriter reports, which I pull on all my files, if a business comes up through the third-party systems, right? Like back when PPP and a lot of the government self-employed loans came out, if you apply for those loans in our underwriting reports, we will be able to see that you had a business. So if a business pops up on that report or you disclose a business, you will be required to provide your tax returns. So keep that in mind. However, if you are in a program where you don't need tax returns, but then you get a tax refund, now we're gonna either need your tax returns or figure out kind of where you got that refund from. So to make a long story short, I know that was a lot of information. We have lots of different programs available, and I do see some questions coming, I think. But with that being said, when you're looking to purchase a mortgage, make sure you get pre-approved and have your loan officer review your documents and make sure that the losses that you take on your tax returns are your true losses, so that way you won't be penalized for them in the future. And it looks like we have some questions.
Yes, so we're gonna put Angela back.
I think I would come in, and just because I work with a lot of people who are in the process of purchasing housing, from a lender to a tax preparer, what are some of the things that you would suggest to me to suggest to my clients as far as
So they can hear you, Tony.
what their debt to income should be when they're trying to purchase a home, and if they should have a certain savings account or what additional information would you give to a tax preparer that prepares taxes for someone purchasing a home?
Okay, guys, just because the heat is on, I think some of that didn't come through. So what she's asking is, what is really, how do you be prepared in how much money you should have, right? Is that what I'm saying? To actually,
Right, right.
On
She
your-
wants to know what's your debt to income ratio. The question is, what is your debt? What would, as a lender, would I recommend my tax preparer to tell a client? So the way debt to income ratio works is if everyone's situation is unique. So the way we look at debt to income ratio is this: just say for you make $1,000 a month. For FHA, we generally can go to 56% debt to income ratio. So that means they can have $560 in debt. That includes their mortgage, their minimum payments on their credit cards, the numbers of the student loans that we use. So that includes all of that. If we were doing a conventional loan, we would be at 50%. Now we have situations where we have manual underwrites, and then we have, if you have a lower score, sometimes the system is a little different. So you want to definitely have your one-on-one consultation. As it relates to what I would tell you, if someone was coming in to file tax returns, my advice would be for them to, file their real situation. So if you're buying a house and you're writing off everything, then we can only use the income that you're paying taxes on. Now, some people do have different type of businesses that come up in their Schedule C world. On an FHA loan, those businesses hurt if they have losses, because now I have to hit them for those losses. So say for instance, I have a client, and I've had this situation before. I have a client that makes $100,000 a year for Google, right? But then they have a Schedule C business because they were working to, and some of my clients don't even know this about the Schedule C business, right? They send their taxes to their preparer, and the preparer says $10,000 refund, congratulations. And they like, yes, I have a refund. But you want to make sure you review your tax returns to figure out, why did you get that refund? Did you get it because you paid that much in taxes, or you received these credits, or was something else done on your tax returns to prevent you from, paying the taxes that you should pay?
Yeah, and so as a professional tax preparer, we shouldn't prepare the taxes with those write-offs without the client giving us that information.
Correct.
We shouldn't be trying to get them a refund. So that is not the purpose of filing your taxes.
And that's why we're bringing you.
Right. We should. So that is incorrect. So if that does happen to you, you shouldn't just be writing off things to try to get your client a refund. That is inaccurate. Anything that goes on the tax return, the taxpayer needs to sign off on it. The taxpayer needs to provide you with a list of that. I also ask my clients to give me some kind of proof. Like I would generally ask for bank statements, so you're not just getting ready to get all of these write-offs just for you to get a refund, which is where people get in trouble.
Exactly. And that's why we need you here today, so we can advise people, right? Because IRS debt is the most expensive debt that you just don't want to have. So with that being said, that's exactly, kind of how it works. Now, it's January, February, now we're going into March tomorrow, and we're about to get into tax extension time, right? So as a lender, you're not required to file your tax returns right now. The only way I'm gonna need your 2022 tax returns is if you just need them because you filed more income in the 2022 year, and that's required for you to become pre-approved, or if you get a tax refund and we see the deposit, then we're gonna know that you have those taxes.
Yes.
On April 15th or 18th,
18.
April 18th is the tax day. So on April 18th, tax returns will be required.
Yes.
And if you have not filed your tax returns on the lender point of view, then you will have to have a tax extension.
Yes, which you can contact me for. I can definitely file the extension for you.
Correct. Now on that extension, sometimes with the accountants print the extension, there's an amount due. So if you have an extension and there's an amount due on the extension, then as a lender, we're gonna make you pay that amount due.
Yes.
Right? So be mindful of that when you do the extension. After that, we won't require tax returns for 2022 until they are required by the IRS, which would be October 15th.
October 15th.
Gotcha, which will be October 15th. So basically, we're just doing the rundown. Now, let's talk also about tax returns. They come with tax transcripts. So as a lender, we are going to pull your tax transcripts.
Yes.
What that is a document that says you actually filed these tax returns. Now, this topic is very important to me because I've had 6 cases in the past 60 days where my client provided me tax returns with a different amount from what they filed with the IRS. So I'm going to tell you what happens in that particular situation. If you give me tax returns that you haven't filed with the IRS, when I receive your tax transcripts, if they don't match, then I have to let you know that they don't match, and we have to have matching tax transcripts.
Yes.
Well, we're not allowed to amend tax returns during a loan application. So in this particular situation, we weren't able to fix it because a client cannot file to qualify, right?
Right.
So in that situation, you want to make sure that the tax returns that you give your lender are the exact tax returns that you filed with the IRS. And my clients, honestly, they were in these unique situations, which is why we're meeting with accounting professionals today, where they had no idea that the accountant filed different information. You know, they didn't know, like there were a few different sets, and this was the set that they honestly thought was filed. And we've had situations where the person that filed their taxes no longer does accounting. So we then had to get a different accountant, or they had to find an accountant to go in and basically amend and fix it with the IRS so it could match. So if your accountant, normally when you file, they give you the envelope, they tell you to mail it, which is going to be the next thing I talk about, because you can file electronic or by mail. So a lot of times, and it happened to me once, your accountant will give you your packet and say, mail this. If you don't mail it, the IRS never received it. So it's in your packet, in your basement somewhere. And a lot of times when we're not getting a refund, it's not as important to us to make sure that it gets out. But if you are looking to purchase a home in 2023, and you are self-employed, or you have a side business in addition to your job, you are going to have tax returns with matching tax transcripts.
Yes.
So definitely be aware of that to help you get through the process. Yeah.
And you should, if your accountant is still in business, you should be able to reach out to them and verify the taxes that they did file. And once again, before your accountant submits your tax return, he should go over with you line item by line item so that you know the amount of taxes that you will be receiving. And that is the copy that you should sign before he submits it. He should also sign that, so your transcript should always match your tax returns.
They have always matched in my career, normally maybe once a year, but this year was very special. This year was very special. And I tell all my clients, like, we pull transcripts. We have to verify. We're going to third party verify all of our income. If you have a job, we're going to third party verify with your employer. If you're self-employed, we're going to third party verify it with your IRS. So you just want to make sure you have your paperwork ready, because I did have a few clients that couldn't purchase their dream home because when we finally got the transcripts, they didn't match up. And I will also say, as a lender, many lenders don't pull transcripts until contract. It should really be done under pre-approval, so that way, once you're under contract and you're excited, if your accountant did make that mistake, then you could be the armor for your client to come back and say, hey, you know, this doesn't match and this doesn't work, well before they are contracted. So that way they're not stressed out during their home buyer experience.
Also, too, there's a number that they can call and verify. So there's a number, and I can provide you with that number. There is a number where you can call the IRS, and the taxpayer can call on their own behalf to verify what was submitted on their behalf.
Gotcha. Yes, and then you can also log into, if you can answer the questions. The IRS is very good now since COVID, where you can get your transcripts online and you can view them. So you can actually see how much you owe. You can set up a payment plan.
Yes.
And you can also see, we got some people in the back.
Look at God, okay?
You can also see what numbers were filed for you. So it's very important, guys. Like, if you're looking to purchase a house, and I want to just, call out all my beauty shop owners and barbershop owners. Guys, if you want to purchase a home and you want to purchase in a conforming world, there are other options such as hard money lending and things like that. But if you want to get an FHA loan, if you want to do a 203K, if you want to do a regular conventional loan and get down payment assistance, you do have to have the tax returns. IDA requires 3 years of tax returns, but as a lender, sometimes we can get away with just 1 year. So on a conventional loan, sometimes we only need 1 year, which is why you should always get pre-approved first, so that way we can review your findings and we can see what do you really need. Because if I only need 1 year, you can file your taxes right in 2023, and we can be in the house in June, right? So sometimes it only takes the 1 year to get you in the door. And I know one of our programs, you have to be self-employed for 5 years, 1 year of taxes, but we do have our Fannie Mae product which will allow you to be in business for 2 years with only 1 year of tax returns. But once again, it depends on your profile, on what the system is going to ask you for.
Look, I get to try this on, okay? Natasha is the 203K girl, and I am her assistant.
We have all props hanging around here.
Yes, I just wanted to put this on. So anyway, but we do have a question about sort of in a renovation-ish area. The question was, if the person is a investor and they built a house and it did not sell in that year, right? And so they have a loss. The other question was, part B of this is, if they're a renter, they're a landlord, and then their home was vacant for 6 out of the 12 months. Mm-hmm. Is there anything they get credit for on their taxes, and should they take that?
So if you own a home and you're renting it out, and it was vacant for 6 months, so you have 6 months of a loss. Is that the question?
Yes, that was one, and then the other one was if they're actually a developer and then it didn't work out. The development didn't, the home did not sell, or it sat empty, or they didn't get the return they needed, or they put more money in it, or whatever.
Yeah, so they would only be that's a very specific question. I would have to see the rest of the income from that particular person as far as the investor goes. But for the rental person, you can only take a rental loss up until the income. So if you had, somebody was there for 6 months and then nobody was there for 6 months, so you had a tenant that, let's just say the rent was $1,000, and then 6 months he got $6,000, and 6 months he got nothing, he can take the loss to the extent of the income.
Wow.
Okay, and what if it was a place that somebody lived in, right? And then they move out and bought another home, and then they decided to do repairs in the place and it sat empty. Can they get that same credit, or it's only if someone was already renting?
So you can get repairs that falls in a different category, but a rental income loss, the income loss is only to the extent of the income. So if you get $6,000 in income, you can take a loss for that $6,000. So repairs would go into a different category. Repairs and maintenance, that goes into a different category. And once again, it depends on what he's already written off. It is possible that he could have some deductions, but it just depends on what his other income looks like.
Okay.
And I have to add that on the lending side, and I am so glad whoever asked that question. So as a lender, regardless of what kind of loan it is, if we're using your tax returns and you file, and if you only rented it for 6 months and you filed $6,000, there is a number of days that your property was rented. Many accountants make the mistake of putting 360 there when it was only rented for 30 days. Mm-hmm. So if it was rented for 30 days and you had $1,000 and you put 30 days in there, then I'm gonna treat that like you got $1,000 every month. Like it's gonna make your taxes look good. But if you put 360 days in there, then I'm gonna have to take that $1,000 and divide it by 12 months. So now instead of you getting $1,000 a month for your property, you're getting 83 or whatever that math is. So you definitely have to make sure that that is one of the biggest mistakes that accountants make on the tax returns, from my experience, where they just pop that 360 in there because it's standard. But if you received $1,000 and you rented that place out 30 days, it's going to be a big difference in how much you qualify for if you put 30 or 360 in that box.
Yes. And that's another reason why whoever does your taxes should go over your taxes with you. Go over with you line item by line item to make sure all the information is correct. And with the virtual world, especially after COVID, everything is done virtual, so that people just get the taxes done. Yeah, get their taxes done, and they just send them to them to sign, especially if they don't, most people, they don't have to pay, or if they get a little money back, they just sign and send it back.
That's the problem we
Yeah,
have.
that is the problem that we have, which is what, I mean, we have Zoom, we have this right here. You can call your client, share your screen, which is, this is what I do with my clients. I share my screen with them. I go over with them line item by line item. Is this correct? Is this what you said? Is this the information that you gave me? Does this information look accurate? Did you rent this for 6 months, or did you rent it for 12 months? Or, you go over that line item by line item, and then you let the client know his liability or what he'll be receiving back as a refund.
Yeah, true. And I think you asked another important question as relates to 203K. If a builder built the house and couldn't sell it, or wanted someone to finish the work on a 203K, it has to have been occupied at least one time. So they have had to have received the certificate of occupancy. But on the home style renovation, that is not required. So a buyer can pick up a renovation deal from a developer on an unfinished product in our conventional world, but on the FHA world, we do require a certificate of occupancy. Someone has to have lived there or had that certificate to occupy in order to get a 203K.
To get a 203K or convention?
To get a 203K. On a home style or a home the Freddie or Fannie program, we can do it on that program. We just can't do it on a 203K.
Okay.
Not continue an unfinished project. More questions?
Yes, I'm gonna pop in. I'm here today. I'm just in the background.
Oh, I forgot to say who we were.
Who are you guys? Oh my God, who are you?
We
Who show
thought
are we
everybody
on?
should know our showing. We thought everybody knows us because we're famous.
Right. It's an intro, at least.
Yeah,
a little, right?
Right.
But we do have a question. The question is, if you are kind of iffy about how your taxes have been filed in the past, now that they're hearing the discussion about, they may not be aware of everything, or if you want to purchase, but maybe you already wrote things off for the last couple of years, can your taxes be amended, and how far back can you go to make any changes? How many years? Should they even consider looking back to see if they need to make any changes?
So you can amend for 3 years back. And if you already wrote stuff off, if it's legitimate write-offs, then you shouldn't change that.
Exactly. If it's legitimate write-off, you shouldn't change it. And many people want to go FHA because it's easy. But we have a lot of conventional programs, especially now with the new pricing adjustments that we get for the lower credit score borrowers. So if you have a 620, you may be able to go conventional. And on a conventional loan, we don't care about Schedule C losses as long as those losses are not your main source of business. So if you're a salesperson and your side business is a salesperson, then yeah, we care. But if you are going to work every day working for the city of Chicago, and then you're a chef on the weekends, on a conventional loan, it doesn't matter. We don't hit you for any of those losses. So the answer to the question is apply and let your loan officer review your documents and let your loan officer advise. We have so many people that just want to go and make their credit perfect and pay everything off when they already have 800 credit scores. And they're like, I don't want to buy yet until, I have this extra money saved. Well, now you got to pay $20,000 more for the property because we waited 6 extra months when we didn't need to. So don't take on that task of trying to figure it out for yourself. Like, reach out to your professional because you may qualify exactly how your taxes are, but like she said, you have to file your taxes for what they legally are. You can't just adjust them to purchase a mortgage, to purchase a home, or to qualify. We're just giving you tips today that if you did things that you should not have, then we're helping you correct it in the future so that way you can have your portfolio together. And on the lending side, if you had a business in 2021 and you filed that business and you had losses, but in 2022, you didn't file that business because it doesn't exist anymore, then that basically erases the business because it no longer exists. So I can't hit you for a business that no longer exists anymore. So it's not all the way, 90% of the time you don't have to go backwards. It's just how you go forward.
It's exactly how you go forward.
Right, and we're here to teach you how to be aware. And if you had a business and you have losses, you have to take your losses because they're your losses, right? And you just want your tax returns to be right. So we're giving this advice because I probably had 50% of the people whose tax returns were filed incorrectly. their response to me, I don't know what that business is. I don't know. So because I heard that so many times this year, that's why my point is, if it's not your business, don't just create a business to make losses, because it can definitely hurt you in the long run.
Exactly. And then if it was losses that you weren't legitimately qualified for, you can get audited and have to pay that money back. So you don't want to do that if you're not really having a
How
loss.
many years can you get audited?
10 years. 10 years. Yeah, you can get audited. So you can get audited.
Lana passed out.
And then have to pay that money back. So you just want to make sure when you file your tax returns that everything on your tax return did actually happen. So make sure that it's legitimate, get with the professional tax preparer, go over those items, make sure that they review everything that they put on your tax return with you, and that you authorize them to do that. And if you did not, don't sign that tax return to be submitted.
If you stay ready, you don't have to get ready.
Yes, so we have one question that's kind of unrelated to taxes, but since Natasha's here, people want to know, because we have scared buyers, on everybody giving all types of different information on whether it's a good time to buy or not. So if you could give us a little synopsis, that's kind of a loaded question, but
So is the question, is it a good time to buy?
yes.
Okay. So is it a good time to buy? Everybody's asking every single day. The question is, it depends on you, right? So if you are renting and you pay $2,000 a month for rent, at the end of the year, you would have spent $24,000. So interest rates are higher. So let's just say your payment increases by $300, and I'm throwing a higher number out there. It could be $80 or it could be $100, based on the interest rate. At the end of the year, when you pay $24,000 of someone else's mortgage, you get $0 back. But you get to write off all your interest, real write-offs that we don't hit you for. You get to write off your taxes.
Yes.
You get to write off your insurance. You get to write off certain repairs to your home.
Yes.
And you're working towards paying your home off. I say this over and over again, but we work hard every day to not work hard every day. So when you purchase and when you own, you're working towards retirement, right? After 30 years, your house has to be paid in full. If you make a certain amount of payments every single month, every single year, if you make extra payments, then you can sometimes knock your mortgage off sooner. But is it a good time to buy? Yes, as long as you find the right house for you, and as long as the payment is affordable to you and your family. What we see your debt as on your loan application is not all your debt. So because the interest rates are a little higher, right? You want to make sure that you can afford your mortgage. And if you can afford your mortgage, you definitely should buy. From my experience recently, I have seen my clients get properties $20,000 and $30,000 under list price. I have seen the seller paying closing costs again. Just 7 months ago, they weren't doing that. So they were getting a lower interest rate, but they were paying 30, 40 extra thousand for the property with zero closing costs. So now you can get into a property, if you qualify for down payment assistance, you can ask for seller concessions. Some of our flippers are scared. So now you have the opportunity to buy a home that needs a 203K, come and get a renovation loan, which is still cheaper than a hard money loan, and get into that property and actually have some equity. My client just closed, I think, 3 months ago with $100,000 in equity before she started, right? Because we're in a different market. So to answer your question, in the shorter term, if you are ready and able to pay for your mortgage, it's definitely a good time to buy, because when interest rates go down, the purchase prices are going to go back up. You can always refinance later, so rent the interest rate and buy the house is what my answer is.
Okay, do we have any other questions, Victoria?
I think we covered them all.
Okay, so I do need to say, because we have to do this little legal thing. We are licensed real estate agents, by the way. Lana Ryland and Victoria Garrett. Okay, now we can put this out there. Facebook, don't come get it.
And my name is Natasha Robinson, NMS number 332074.
Angela Lakes, AEI Stewards, professional tax preparer and accountant.
Yes, okay, guys, we are super excited. If there are other questions, we know where to find these ladies. And we will be reposting this so that you guys can see it. But if you have a pressing question or you want to come and get your taxes done with Angela, that is not a problem. You can find us and we will put her information in the chat. Also, Natasha is great. She's in Brownsville. and we will send you everybody that sees this to her so we can get y'all out in these streets. Okay, that's
We'll
okay?
purchase some homes.
Yes. Thank you and goodbye.
Wait. Victoria, where is everyone going? Is everyone leaving?
Yes, Lana. The show's over.
But wait, I have more to say. Is my mic still on? Can they hear me? What if they have more questions?
Well, they can always contact us.
How? How will they reach us after this show?
If you have any questions, our contact information is on the screen. Otherwise, we'll see you again in a couple weeks.